There is no doubt that we are currently in a recession, and with the looming stock market crash ahead, people need to start proceeding with caution in navigating the economic waves that are about to hit. There are key activities that are indicators that things are about to get worse. The Fed is printing huge amounts of money. Citizens in the US are now all receiving stimulus checks into the foreseeable future, and businesses are getting bailout funds from the government to keep them afloat. With millions now in unemployment, we may be at the brink of a much bigger recession than we first anticipated. In this video, I will discuss some key ways to invest during this economic uncertainty and how you can prepare yourself to navigate the recession by making savvy investments to grow wealth over time. Get ready. You are now entering the Academy. With many people now entering retirement and many depending on their 401ks or pensions to live off of, there are a few key factors to consider given the current economic environment that we're currently in. Firstly, for those depending on pensions, many companies that offer pensions are highly dependent on the stock and credit markets. The credit markets are where companies borrow money by issuing bonds, and the pensions buy them because they get a yield on them. The problem arises when there is an economic downturn and business cycles start going down. This sets off a domino effect which not only affects the stock market, but the credit market as well, which pensions rely on. The matter of fact is, during the last 5 years, the stock market has been propped up basically by companies buying back their own shares to increase the price per share of their stocks. The less shares that are available to trade on the open market, the more valued their shares become. But millennials are not buying that many company shares, and baby boomers are already retiring and selling off their portfolios for income to live off of. And now, with this economic recession, with companies beginning to suspend and stop share buybacks, share prices should begin to stagnate and or eventually start dropping significantly. With no buyers of equities and no buyers of corporate credit, and the Fed coming in to buy some of this credit, this is setting up for a massive bubble which is sure to pop rather soon. With a gap in valuations across all markets, stock market and real estate markets at all-time highs, and saving interest rates at all-time lows, there's really no place for new investors to invest their money safely. The propping of these markets by printing more money is a dangerous scenario that will eventually cause inflation and a deep recession until things normalize again, which could take years. So what are good investments during these troubled times? Well, to de-risk one's portfolio, we must consider assets that have not only the probability of maintaining their value, but also growing in value over a recessionary period. The first asset to consider is gold. The easiest way to put your money in gold is to buy physical gold, such as coins, bullion, or even jewelry. There's always a risk in buying gold, as the price of gold tends to be very volatile and there is high risk of losing value in your investment over the short term. To make a profit off of gold, you need to have a reasonable expectation that there can be expected volatility and that over time the price of gold will go higher. But gold prices are notoriously difficult to predict. In the 1990s, gold barely hit $300 on a good day. Then as financial and political crisis loomed in the mid-2000s, people did what they always do and started buying up gold. Its value more than doubled from $800 an ounce in 2009 to $1,900 in 2011. But by 2013, the bubble had bust and gold was down to $1,300. Recently, it has been hovering in the $1,600 range with a higher probability that it will make new all-time highs. Nevertheless, if you look at physical gold at least as a store of value, buying at the right time can allow your asset to hold its value and perhaps slowly appreciate over time, versus traditional money and currency that will most definitely depreciate over time due to inflation. The next asset to consider is crypto, specifically Bitcoin. I will not go into what Bitcoin is or how to invest in it, as there are many videos on YouTube on the subject, but I will discuss the pros and cons of investing in Bitcoin. Investing in Bitcoin takes on asymmetric risk, which is a high risk, high reward type of investment. But the reward risk fairly outweighs the risk of devaluation. Can the value of Bitcoin go to zero? It is highly unlikely at this point, as it has been able to survive despite all the negative media and significant drops over periods of time. But what investors in Bitcoin are banking on is the high reward aspect of Bitcoin, where the value could multiply by 50 or even 100 times its current value. Investing in Bitcoin could provide a great hedge against the currency system and the value of currencies held around the world, making it a great asset to own during recessions and economic downturns. The third asset to consider for an investment is not really an investment at all. It is cash. During recessionary periods, cash is king. It allows one to enter positions at true undervalued valuations, allowing one to maximize their profits and earn dividends along the way. And in case that we have a prolonged recession where the economy and the markets go down or trade sideways for an extended period of time, investing in value dividend stocks makes the most sense. Not only is one getting the most bang for their buck by investing in solid companies that are not only undervalued but have strong balance sheets and are not over leveraged in paying out dividends, but they also provide a great way to earn passive dividend income over an extended period of time. By employing the investment strategies mentioned in this video, which include diversifying one's investment, investing in physical metals such as gold and virtual currency such as Bitcoin, and holding cash during recessionary markets provides the greatest benefits in taking advantage of economic downturns and turning assets into not only capital gains, but eventually passive income that can generate wealth over the long term. Be sure to check out the links in the description to learn more about investing in crypto and investing in undervalued dividend stocks that can provide passive income through recessionary periods. Through careful planning and diligent investment of capital, as well as smart money management and reinvestment of profits and dividends into one's portfolio, one can create income streams that can provide substantial income, eventually covering everyday expenditures and beyond. Thank you for watching this video. If you enjoyed watching, don't forget to smash the like button. It will really help out the YouTube algorithm in bringing you more wealth creation strategy videos. And if you haven't done so already, be sure to subscribe to the 10X Academy. And don't forget to turn on the notification bell to be alerted on more passive income strategy videos. This is the 10X Academy.